Something extraordinary is happening in the gold market right now, and if you're not paying attention, you could miss one of the most significant wealth transfers of this decade. I'm talking about movements that don't happen by accident, movements that signal something much bigger is coming. Let me show you what I'm seeing, because the pieces are falling into place in a way that should have every investor sitting up and taking notice. Right now, gold is trading near all-time highs, but here's what most people are missing. The price action we're seeing isn't driven by retail investors panicking or some temporary flight to safety. This is institutional money moving in size. This is central banks accelerating purchases at a pace we haven't seen in over 50 years. This is smart money positioning for something they see coming down the pipeline. And the question you need to ask yourself is simple. What do they know that you don't? Let's start with what's happening right now in the physical market, because this is where the real story begins. The Shanghai Gold Exchange, which is the world's largest physical gold exchange, has been showing persistent premiums over London and New York prices. Now, in a normal market, gold prices should be relatively uniform across major trading centers, but we're not in a normal market. These premiums tell us that physical demand in Asia is so strong that buyers are willing to pay more than the paper price just to get their hands on actual metal. We're talking about premiums that have ranged from $20 to $50 per ounce at various points this year. That's not noise. That's a signal. And it's not just China. India, the world's second largest gold consumer, just reported record import numbers. We're talking about imports that exceeded 100 tons in a single month. To put that in perspective, that's more than some countries hold in their entire national reserves. Indian households, which collectively hold more gold than any central bank on earth, are buying at a pace that suggests they see something coming. But here's where it gets really interesting. While Asian buyers are scrambling for physical metal, something unusual is happening in the Western paper markets. The COMEX, which is the primary futures exchange for gold in the United States, has seen its registered inventory, the gold that's actually available for delivery, drop to levels that should concern anyone paying attention. We're talking about inventory levels that represent less than 3% of open interest. In plain English, that means if even a small fraction of futures contract holders decided they wanted physical delivery instead of cash settlement, the exchange wouldn't have enough gold to meet demand. This is the kind of structural tension that precedes major price dislocations. Now let me tell you a story that illustrates exactly what I'm talking about. Back in 1980, the Hunt brothers tried to corner the silver market. They accumulated massive positions in silver futures and started taking physical delivery. The exchanges changed the rules mid-game, but not before silver went from $6 to $50 an ounce in a matter of months. The point isn't whether what they did was right or wrong. The point is what happens when paper markets meet physical reality. We're seeing echoes of that dynamic right now, but on a much larger scale and with far more sophisticated players. Central banks aren't trying to corner the market. They're simply trying to own more of a finite asset in a world where currency debasement has become official policy. Speaking of central banks, let's talk about what they're actually doing, because this is the part that should really get your attention. According to the World Gold Council, central banks purchased over 1,000 tons of gold last year. That's the second highest annual total on record. But here's the kicker. The buying hasn't slowed down. If anything, it's accelerating. China's central bank reported 29 consecutive months of gold purchases before they stopped reporting the data publicly. Think about that for a second. They bought gold every single month for more than 2 years, and then they just stopped telling us about it. Does that sound like they stopped buying? Or does that sound like they don't want the market to know how much they're accumulating? Poland's central bank governor went on record saying they plan to increase gold reserves significantly. Turkey has been buying aggressively. India's central bank has been adding to reserves. Even countries you wouldn't expect, like Singapore and the Philippines, have been increasing their gold holdings. This isn't random. This is coordinated de-dollarization in action. These countries are looking at a world where the US dollar's dominance is no longer guaranteed, and they're positioning accordingly. They're buying the one asset that has served as money for 5,000 years, the one asset that doesn't depend on any government's promise or any central bank's balance sheet. Now, let me connect this to something that's happening right now that most people aren't talking about. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several new members, have been openly discussing alternatives to the dollar for international trade. They're not just talking anymore. They're acting. Russia and China are settling trade in their own currencies. Saudi Arabia is accepting yuan for oil sales. The United Arab Emirates is stockpiling gold. These aren't isolated incidents. This is a fundamental restructuring of the global monetary system, and gold is at the center of it. Here's why this matters to you. When the world's reserve currency status is in question, when major economies are actively working to reduce their dependence on that currency, the implications for anyone holding wealth in that currency are profound. We're not talking about some distant theoretical risk. We're talking about a process that's already underway. And the gold market is telling us this story in real time if we know how to read it. The persistent strength in gold prices, despite rising interest rates, despite a strong dollar at various points, despite every reason the traditional models say gold should be weak, tells us that something bigger is driving this market. Let me give you another piece of the puzzle. Gold mining production has been essentially flat for years. The easy gold has been found. The high-grade deposits have been mined. What's left requires more capital, more time, and more risk to extract. Meanwhile, demand from every sector, jewelry, technology, investment, and central banks continues to grow. This is basic supply and demand, but with a twist. Unlike other commodities where higher prices eventually bring more supply to market, gold doesn't work that way. You can't just decide to produce more gold because the price went up. It takes 7 to 10 years to bring a new mine into production, and that's if you can even find a deposit worth developing. So we have structurally constrained supply meeting accelerating demand from the world's most powerful institutions, and we have a paper market that's increasingly disconnected from physical reality. This is the setup for a price move that could dwarf anything we've seen before. Now, let me talk about something that's relevant if you're thinking about your retirement security. A lot of people don't realize that you can actually hold physical gold in a retirement account. I'm talking about a gold IRA, where instead of having your retirement savings in stocks and bonds that are subject to market crashes and currency debasement, you can hold actual physical gold and silver. I put together a free guide that explains exactly how this works, how to do it without triggering taxes or penalties, and what you need to know if you're sitting on $100,000 or more in retirement accounts. It's in the description below. No pressure, but if you're concerned about the things we're discussing, it's worth understanding your options. The guide covers everything from the rollover process to storage requirements to the tax implications. All right, back to what's happening in the market right now, because there's another layer to this story that's absolutely critical. The relationship between gold and real interest rates, which is interest rates minus inflation, has broken down. Traditionally, when real interest rates rise, gold prices fall. That's because the opportunity cost of holding gold, which doesn't pay interest or dividends, increases. But look at what's happened over the past 2 years. Real interest rates have been positive, sometimes significantly positive, and gold has still been making new all-time highs. This tells us that the traditional drivers of gold prices are being overwhelmed by something else. That something else is a loss of confidence in the system itself. When people and institutions start to question whether their currency will maintain its purchasing power, when they start to question whether their government bonds are truly risk-free, when they start to question whether the financial system is as stable as they've been told, they buy gold, not because gold pays a yield, not because gold is going to revolutionize some industry, but because gold is the ultimate form of financial insurance. And right now, the insurance premium is rising because the perceived risk is rising. Look at what's happening in the banking sector. We had 3 major bank failures last year. The Federal Reserve had to create emergency lending facilities. The FDIC's insurance fund is under pressure, and that's just in the United States. Europe has its own banking concerns. China has a real estate crisis that's threatening its banking system. This is the environment where gold shines, literally and figuratively. It's the asset that doesn't depend on any institution's solvency. It's the asset that can't be printed or created out of thin air. It's the asset that has survived every financial crisis, every currency collapse, every empire's rise and fall for millennia. Let me tell you about what happened in 1971, because there's a parallel to today that's almost eerie. In August of that year, President Nixon closed the gold window, meaning the U.S. would no longer convert dollars to gold at the fixed rate of $35 per ounce. This was supposed to be a temporary measure. It became permanent. What happened next? Gold went from $35 to over $800 by 1980. That's not a 20% gain or a 50% gain. That's a 2,200% gain in less than a decade. And it happened because the world realized that the dollar was no longer backed by anything except the government's promise. Now, I'm not saying we're going to see that exact scenario play out again, but I am saying that we're in a similar moment of monetary transition. The difference is that this time, it's not just the U.S. making unilateral decisions. It's the entire global monetary system being renegotiated in real time. And here's something that should really make you think. The total value of all the gold ever mined in human history is around $15 trillion at current prices. That sounds like a lot, until you compare it to global debt, which exceeds $300 trillion, or global money supply, which is over $100 trillion, or the derivatives market, which is measured in the quadrillions. Gold represents a tiny fraction of global financial assets. If even a small percentage of that money decides it wants to own gold instead of paper promises, the price implications are staggering. We're not talking about gold going up 20 or 30%. We're talking about a potential revaluation of gold's role in the monetary system. Look at what's happening with gold ETFs. After years of outflows, we're starting to see institutional money come back into gold through these vehicles. But here's what's interesting. The outflows from ETFs over the past couple of years didn't correspond with falling gold prices. Why? Because the physical market absorbed that supply and then some. This tells us that there's a deep bid under the gold market from buyers who want physical metal, not paper exposure. And when the institutional money comes back into ETFs, when the retail investors start paying attention again, that's when the price action could really accelerate. Now let's talk about the technical picture, because the charts are telling a compelling story. Gold has been in a consolidation pattern for months, building a base above $2,000. Every time it's pulled back, buyers have stepped in. Every time it's broken out to new highs, it's held those gains. This is the kind of price action that precedes major moves higher. The $2,000 level, which seemed like an impossible target just a few years ago, is now support. Think about that. The market has completely repriced gold's value, and it's not going back. The next major resistance level is around $2,300. And if that breaks, there's not much overhead resistance until we get to levels that would have seemed absurd to mention just a year ago. But here's what you need to understand about gold. It's not about trying to time the perfect entry or exit. It's about recognizing that we're in a secular bull market driven by fundamental forces that aren't going away. Currency debasement isn't stopping. Debt levels aren't coming down. Geopolitical tensions aren't easing. Central bank buying isn't slowing. These are the tailwinds that drive gold higher over time, regardless of short-term volatility. And the volatility is actually your friend if you understand what you're doing. Every pullback is an opportunity to add to positions at better prices. Every consolidation is the market building energy for the next leg higher. Let me give you another historical parallel. In the 1970s, gold didn't go straight up from $35 to $800. It had massive pullbacks. It had periods where it seemed like the bull market was over. In 1975, gold fell from $200 back to $100. People who sold at the bottom missed the move to $800 that followed. The point is that bull markets in gold are characterized by volatility, but the overall trend is unmistakable when you zoom out. And right now, when you zoom out on the gold chart, what you see is a market that's been in an uptrend since 2001, with the most powerful phase of that trend potentially just beginning. Here's something else that's happening that most people aren't connecting. The U.S. government's fiscal situation is deteriorating rapidly. We're running trillion-dollar deficits as far as the eye can see. The debt-to-GDP ratio is at levels that historically have led to currency crises, and the political will to address this simply doesn't exist. What does this mean for gold? It means that the government's incentive is to inflate away the debt. It means that the purchasing power of the dollar is going to continue to erode. It means that anyone holding significant wealth in dollar-denominated assets needs to think seriously about diversification. And gold isn't just a hedge against dollar debasement. It's a hedge against the entire system of fiat currencies. Because what's happening in the US is happening everywhere. Japan's debt-to-GDP ratio is over 200%. Europe is dealing with its own fiscal challenges. China is trying to manage a debt bubble while maintaining growth. Every major economy is trapped in the same dynamic. Too much debt, too little growth, and the only solution is to print more money and hope for the best. This is the environment where gold has historically performed best, and we're in the early innings of this cycle. Now, let me talk about something that's happening in the silver market, because it's related and it's important. Silver has been even more volatile than gold, but it's also been showing signs of life. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been coming down from extreme levels. Historically, when this ratio gets very high, it means silver is cheap relative to gold. And when it starts to come down, it often means silver is beginning to outperform. We saw this in 2010 and 2011, when silver went from $15 to nearly $50 in a matter of months. Could we see something similar? The setup is certainly there, but whether you're focused on gold or silver or both, The key is understanding that we're in a precious metals bull market driven by forces that are much bigger than any individual investor or even any individual country. This is about the global monetary system being restructured, and precious metals are the beneficiaries. Let me bring this back to what you should be thinking about right now. If you're sitting on cash, you're losing purchasing power every day. If you're fully invested in stocks, you're exposed to a market that's trading at historically high valuations while economic uncertainty is rising. If you're in bonds, you're locked into yields that don't compensate you for inflation risk. Gold offers something different. It offers protection against the scenarios that keep people up at night: currency collapse, financial system instability, geopolitical chaos. These aren't far-fetched scenarios anymore. They're real risks that are being priced into the gold market right now. And here's the thing about gold. You don't need it to go up for it to do its job. If gold just maintains its purchasing power while everything else loses value, you've won. But if gold does what it's done in previous crisis periods and significantly outperforms other assets, you've really won. The smart money understands this. That's why central banks are buying. That's why billionaire investors are allocating significant portions of their portfolios to gold. That's why family offices and sovereign wealth funds are increasing their precious metals exposure. They're not doing this because they think gold is going to make them rich quick. They're doing it because they understand that preserving wealth is just as important as growing wealth, and in times of monetary instability, gold is the ultimate wealth preservation tool. So, what's the big thing that gold markets are reacting to? It's not one thing. It's the convergence of multiple powerful trends all pointing in the same direction. It's the end of the post-World War II monetary order. It's the rise of a multipolar world where the dollar's dominance is being challenged. It's the recognition that decades of debt accumulation and money printing have consequences. And those consequences are playing out right now in the gold market. The price action we're seeing isn't random. It's not speculation. It's the market's way of saying that something fundamental has changed and the old rules no longer apply. If you're paying attention, if you're positioning accordingly, you have the opportunity to not just protect your wealth but potentially grow it significantly in the years ahead. But you have to act. You have to understand what's happening and make decisions based on that understanding, not on hope or fear or what some talking head on television is telling you. The gold market is sending a signal. The question is whether you're listening. Because the institutions are listening, the central banks are listening, the smart money is listening, and they're acting on what they're hearing. This is your moment to decide whether you're going to be positioned for what's coming or whether you're going to be caught off guard when the full implications of these trends become obvious to everyone. The choice is yours, but the window to act while gold is still relatively affordable compared to where it could be heading is closing. Pay attention to what the market is telling you. Pay attention to what the institutions are doing. And most importantly, pay attention to your own financial security and take the steps necessary to protect it. Because what's happening in the gold market right now isn't just interesting. It's a warning and an opportunity rolled into one, and how you respond could define your financial future for decades to come.